In the latest interview with CNBC, Tom Lee stayed bullish with U.S. stock market. He said, quote unquote, I wouldn't be too worried about the next 12 months. So what's his reasoning behind the bullishness? He believes that the economy is showing resilience with inflation decreasing and the Federal Reserve adopting a more favorable stance, so pretty much a less hawkish stance due to the decrease of the inflation. And this chart shows you the CPI, the US CPI of 5-year chart. As we can see right now, we're very close to the 2% long-term inflation goal set by the Federal Reserve. Tom Lee said interest rates are stabilizing, which supports both equity market and housing market. Tom Lee said historical patterns suggest that a market may outperform or perform well even after 2 consecutive 20% up years. Okay, so this is a S&P 500 chart. As we can see, since 2023 to 2024, for that 1 year, it saw a 22.5% gain. And from 2024 till today, year to date, we are already seeing a 27.2% gain. And historically speaking, when we have 2 consecutive year of 20% plus gain on the S&P, usually the year following that is performing pretty well, according to Tom Lee. Tom Lee said there is $7 trillion in cash on the sideline, waiting to deploy. Okay, and waiting to could be used as a fuel for the future investment, of course. And this is a chart from the Investment Company Institute, or ICI. It's telling us that as of November 26, the total amount of money market fund is currently sitting at $6.7 trillion. And that's what Tommy was talking about, the $7 trillion cash on the sideline waiting to deploy. And this is a historical pattern, is telling us something, right? This is from the Fed. It's showing us the total value of the money market fund in the US. And as we can see, a chart from 1994, since 1994, the total value of money market fund, they tend to increase when the interest rates are higher or when the Federal Reserves are more hawkish. Conversely, when the interest rates are being lowered, the fund will flow out of the money market fund, will go back into the investment, like the stock market or the housing market. And right now, we are here, right? It's still going a uptrend. But since, as we mentioned before, the Federal Reserve is lowering interest rate, and maybe these money, almost $7 trillion value in money market fund, will be deployed as the lower interest rate. Historically speaking, right, when the COVID happened, when they floored the interest rate, we do see a dip over here. And the Great Financial Crisis, when they floored the interest rate, we see a dip in the money market fund, right? Same as the dot-com bubble, when there's a decrease in interest rate, we see a decrease in money market fund, or in other words, deploying of the cash back into the market. Tom Lee also mentioned that the sentiment improved based on AAII sentiment survey, and this chart shows you the AAII sentiment survey of a 5-year chart. The blue represents the bullish views or percentage of bullish survey takers, and red represent the bearish percentage of the survey takers. And as we can see, the bull and bear have a pretty good spread. Okay, and last time we had this type of spread was in 2021. Tom Lee has also said that a new administration in 2025 is seen as pro-growth. The exact term he used is pro-animal spirits, with policies favorable to the markets. And but he still realized that there are risks. He said risks remain from slowed job growth, housing and auto affordability issues, and trade uncertainties like potential tariffs. I do want to add that a very popular economist, Jeremy Siegel, recently said that Donald Trump is the most pro-stock market president in the American history. I'm not too surprised that Jeremy Siegel said that, because Donald Trump does love to mention the phrase stock market.
The stock market has gained trillions of dollars in value since my election and has reached record highs. The stock market is up very, very big today. We've set new records, and I think they'll be continued to set. The stock market is hitting one all-time record after another, boosting your 401ks and retirement accounts for everyday Americans. Everybody happy with your 401k? The stock market is shattering one record after another. We have broken a lot of records. We're breaking another one today. The stock market is way up. Jobs are back. We're setting a record literally all the time. The stock market smashes one record high after another. The stock market is smashing one record after another.
So now back to Tom Lee. Which sector would outperform? Tom Lee believes that small cap stocks and cyclical stocks are expected to perform well, with some investors shifting focus away from the large cap tech, or we call that Magnificent Seven, or in old terms, the FANG, F-A-N-G. I'm here adding a chart to support his idea. As right now we do see that year to date 2024 through November 21st, the percentage of stocks that are outperforming the S&P 500 index is around 35%, but the median is at 48% since the data since 1990. Okay, so this is telling us that we still have a very high concentration in the top large cap technology stocks. There could be, okay, supporting Tom Lee's view, there could be money shifting away in the future from that high concentration into other less loved sectors like the small caps or the cyclical stocks. But Tom Lee did say that investors currently are divided on whether to favor cyclical or large cap tech stocks. Based on the survey, Fundstrat, or pretty much the institution that Tom Lee is the owner of, Fundstrat recently conducted a survey. Based on that survey, it seems like institutional investors, aka the smart money, are leaning towards cyclical stocks, while the retail advisors, okay, so pretty much the professional financial advisors geared towards retail investors, these advisors are leaning towards large cap technology stocks. Thank you very much. Please don't forget to like and subscribe.